After nearly 3 decades under Yum Brands, Pizza Hut is getting a new owner in a deal worth $2.7 billion, hence marking one of the biggest shake-ups in the global fast food industry this year. Yum Brands announced that it will sell Pizza Hut in 2 separate transactions. Private equity firm Long Range Capital will acquire the restaurant chain's business outside mainland China for $1.5 billion, while Yum China Holdings will purchase the mainland China operations for $1.2 billion. The company expects both deals to be completed during the third quarter of this year, subject to regulatory approvals.
A company owns 3 of the most recognized fast food brands on the planet. It operates across 155 countries. It just had its best year ever. EPS up by 10%, global system sales up by 5%, and it just sold one of its own brands for $2.7 billion because that brand had become a liability. That brand is Pizza Hut. That company is a Yum Brands. And the decision tells you everything about how modern portfolio governance works and where India fits into the story. Hi, this is Indranil and you are watching the Spotlight Beyond Profession. Beyond headlines, beyond borders. Today we decode one of the biggest corporate food decisions of 2026 and what it reveals about franchisee risk, brand governance and the future of the Indian QSR market. Let's start with the facts on Yum Brands' own scorecard. In Q2 2025, the numbers told the whole story clearly. KFC and Taco Bell growing. KFC with positive 5% system sales, 8% positive operating profit. Taco Bell 6% positive sales, 5% positive operating profit. KFC opened nearly 3,000 new units in financial year 2025 alone. Pizza Hut bleeding. Negative 1% system sales, negative 15% operating profit. US same-store sales fell by 4% in Q1 26. System-wide sales down by 8% in financial year 25. The trend had been negative for multiple consecutive years. The new CEO, Bryce Turner, who took over in October 2025, didn't need long to reach his conclusion. By November, Yum announced a strategic review of Pizza Hut. By June 26, the sale was done. $1.5 billion to private equity firm Long Range Capital for everything outside mainland China and $1.2 billion to Yum China for the China business. For context, Pizza Hut was built by the passion of 2 brothers in Wichita, Kansas in 1958. It became part of PepsiCo in 1977. It's been inside Yum's portfolio for nearly 4 decades. This is not a routine divestiture. This is a corporate confession that inside a multiple brand portfolio, a laggard brand can destroy capital allocation discipline if you hold on too long. Now let's zoom into India because the India story is where the real complexity lives. Yum operates in India through 2 listed franchise partners. Devyani International, backed by billionaire Ravi Jaipuria's RJ Corporation, and Sapphire Foods. Together, they ran over 3,000 KFC and Pizza Hut outlets. Past tense, because in January 2026, they announced a $934 million merger, with Devyani absorbing Sapphire in a share swap deal.
Sapphire Foods has approved its merger into Devyani International, confirming what we had reported earlier. Under the approved deal, Sapphire Foods shareholders will receive 177 shares of Devyani International for every 100 Sapphire shares, or a 1:1.77 swap ratio, that is. The merger is planned to take effect from April 1st, 2026, subject to approvals from regulators, shareholders and the courts, of course.
The merger math. Devyani issues 177 shares for every 100 Sapphire shares. Expected synergies 210 to 225 crore annually from year 2. The combined entity will have revenue of roughly 7,827 crore and operate across more than 280 cities in India. But here is what the merger announcement doesn't hide. Both Devyani and Sapphire reported losses in the September 2025 quarter. Pizza Hut India same-store sales growth for Sapphire was -9% in financial year 26. For Devyani, it was -5.3%. Sapphire's Pizza Hut revenue fell by 7% in financial year 26 to just 506 crore. Devyani's Pizza Hut revenue fell by 1.6% to 720 crore. Why? One answer: Domino's. Jubilant Foodworks, the Indian operator of Domino's, reported revenue of 6,104 crore in financial year 25, growing by 14.2%. That is more than 8 times Pizza Hut India's combined revenues. Domino's now operates 2,179 outlets across 475 Indian cities. Pizza Hut across both franchises is at roughly 900 outlets, and Domino's digital penetration, delivery and app-based orders had already transformed it into a logistic tech company that happens to sell pizza. Pizza Hut arrived late to delivery and never fully caught up. The Indian pizza market in 2026 is not a two-horse race. Beyond Domino's, you have Pino'z, a Chandigarh-born chain that progressively expanded into Tier 2 and Tier 3 cities with a lower price point, now over 700 outlets nationally. You have Oven Story, the digital-first D2C pizza brand that scaled through dark kitchens and aggregator platforms without carrying the cost of dine-in real estate. And you have a whole ecosystem of cloud kitchen pizza brands, Biryani by Kilo, Box 8, eating into the delivery occasions. Pizza Hut's challenge isn't just Domino's. It is the entire structural shift from dine-in casual to delivery-first QSR. Pizza Hut was built as a sit-down restaurant. The Indian consumer moved to delivery. Pizza Hut's format never fully pivoted. Here, the Spotlight Media and Technologies governance lens on this, and this is what most business coverage misses. Yum Brands was named to the Dow Jones Sustainability Index North America in 2024. It was recognized among Time Magazine's best companies for future leaders in 2025. Its ESG credentials were intact, but here is the inconvenient truth. Holding a structurally declining brand while capital could be redeployed into higher returning assets is itself a governance failure. ESG compliant firms must apply the same accountability to brand portfolio decisions that they apply to carbon targets or supply chain audits. Delayed exit from poor performing assets are a capital stewardship failure, not just a strategic one. Yum's 4 billion incremental share buyback announced alongside the Pizza Hut sale tells you exactly what the board thinks about where capital belongs. They are giving it back to shareholders rather than reinvesting it in a brand that cannot earn its cost of capital. That is governance acting as it should. For the Indian franchises, the Devyani Sapphire merger is also a governance response to a structural problem. Two operators running the same brands in overlapping geographies, both posting losses, was not a sustainable model. Consolidation was not optional, it was overdue. So where does this go, and is there an opportunity here? 1. For long-range capital and the new Pizza Hut, the PE firm's founder led the Arby's turnaround. Pizza Hut has 15,500 restaurants in 108 countries and $10 billion in annual system-wide sales. The brand has equity. It just lacks operational focus and format clarity. A linear ownership structure with QSR specialist leadership is precisely what its delivery pivot requires. Watch for aggressive Delco delivery carry-out format rollout globally through 2027. 2. For Yum brand, post-sale, Yum become a clearer two-engine company. Taco Bell, the value innovation leader, and KFC, the global development machine that nearly 3,000 new units in financial year 25. Taco Bell's US loyalty membership grew over 20% in financial year 25. KFC's digital sales grew by 20% year-on-year. These are compounding structural advantages. The sale removes the drag. 3. For India, the opportunity question. Under the new long-range ownership, Pizza Hut India will need a clear strategic partner. The Devyani Sapphire merger entity will likely retain the franchise rights, but here is the real opportunity. Any operator with a deep delivery infrastructure, stronger Tier 2 and Tier 3 city reach, and the ability to convert Pizza Hut's dine-in footprint into omnichannel assets could unlock significant value. India's QSR market is projected to reach $57 billion by 2030. The pizza category has room, just not for a brand still operating like it is 2005. The new Pizza Hut India needs a delivery-first reset, local menu innovation, and aggressive pricing to close the gap with Domino's. And 4. The franchisee governance lesson. The Devyani Sapphire story teaches a universal lesson. In franchise business models, territorial fragmentation destroys value. Two operators of the same brand competing in overlapping markets drive up cost, confuse customer experience, and reduce bargaining power with the franchisor. Single operator models with clear territorial exclusivity and strong unit economics are the foundation of a sustainable franchise business. India's QSR sector needed this consolidation lesson earlier. Yum Brands didn't sell Pizza Hut because it gave up. It sold because good governance demands you cut what is consuming your energy, your capital, and your management bandwidth before the drag becomes a crisis. For Pizza Hut, this is not an obituary. It is a reset. For India, it is a signal. The QSR market here is real, growing, and unforgiving. You don't survive on nostalgia. You survive on delivery times, unit economics, and governance discipline. The pizza war in India are not over. They are just beginning with a new player at the table who has nothing to lose and everything to prove. Please subscribe to the Spotlight Beyond Profession for intelligence that goes beyond headlines. Is Long Range's Pizza Hut turnaround credible? Could a new Indian operator take Pizza Hut back to growth? Drop your analysis below. Thank you very much for watching and signing it off.